Hey guys, JH here. We're back on lesson 2. I hope you guys watched lesson 1. If you haven't, go back and watch lesson 1. So let's get to work. Need you guys to focus on every slide, okay? What does it mean when you buy Euro USD? All right, you're gonna open the broker platform and you're gonna see all these pairs right there. And you'll be like, what is this? What am I buying? What am I selling? So when you buy Euro USD, you're buying euros and you're selling dollars. So when you go to exchange shop, for example, you have euros, you want to exchange them to dollars. You give him euros and he's going to give you back US dollars. In return, he's going to take a small commission. That commission is called a spread. All right? You're going to hear that word a lot. So you better know what spreads are. What is a spread? Spread is how many pips each platform decides to steal from you. So it depends on the broker. The lower the spread, the better. So obviously, people go look for the best exchange shops physically, for example, just so they can not lose a lot of money on each exchange. For example, here, USD CHF, 0.9071 and 0.9072. As simple as that. The spread here is 5. Basically, you just have to subtract them from each other and you'll know the exact spread. So the lower the spread is, the better, because on each trade you open, they take less money from you on the transaction. It's as simple as that. I don't know if you guys heard about this, but each pair actually has a nickname. And if you go on Bloomberg, on CNN, all these professional business channels, they might be using these words a lot. It's better that you're acquainted with them. You can take a screenshot and memorize these if you want. So Euro USD is fiber, GBP USD is cable, USD JPY is gopher, NZD USD is kiwi, USD CAD is loony, AUD USD is Aussie, and USD CHF is Swissy. Now let's get back and continue our journey, guys. Alright guys, so we're gonna go to the 3 types now, and before we get into that, please guys hit the subscribe button, support this channel. I'm gonna be posting videos on the weekly. Also like the video and put the notifications bell on. Thank you. Now we can move on to the 3 types. So there's 3 types of traders. There's a swing trader, a day trader, and a scalper. Now, what does a swing trader do? Its name gives it away. It's a trader that opens a trade for the long run. All right. So the trader is working on a long game, opens a trade and leaves it going for weeks, for months. And they get out usually at big trend reversals. A day trader is a trader that opens a trade within a day and closes it in the same day. Usually they don't like to hold positions overnight. They have their own reasons. They trade on the daily. They have time for it. Depends on the type of trader you are. And the 3rd type of trader is scalper. So scalpers are, in my opinion, risk takers, because they're going to have to use bigger lots, bigger risk, and a tighter stop loss, and a tighter take profit. So the take profit of a scalper is going to be like 5 to 10 pips. It's a quick hit and run, you could say. We're going to be looking at 3 types of charts right now. There's the bar chart. The bar chart is comprised of bars. There's the line chart. The line chart is comprised of a line. And the candlestick chart, it's comprised of candles. Now each chart serves a purpose. All right. So we're going to get into more detail later. There's 3 types of movements in the market. So there's the uptrend. This is when the bulls take over. All right, so remember in the last lesson, the bulls took over. It means the price is rising. There are a lot of buyers in the market. The market would be bullish and there would be higher highs and higher lows in the chart. All right, so as you can see in this chart, there's higher highs and higher lows forming on the chart. On the downtrend, you would see the complete opposite. The bears are taking over. The price is bearish. It will keep falling. The bears have control of the market. And you can see in the chart right now in front of us, there's higher lows and lower highs forming on the chart. Now on a ranging market, you would see a ranging market usually on a slow market, on a low liquid market where there is no direction. You could draw your support and resistance lines. It's a small range. It's gonna go between that zone, up and down. No big movements. All right, so we're finally gonna get into some serious business. We're going to support and resistance now. Let's go, guys. This is where the fun starts. Let's see how you find support and resistance levels. First, as mentioned earlier, we use the line chart to properly determine the levels since it's easier to use. So don't use a bar chart and don't use a candlestick chart. Professional traders use a line chart to determine the support and resistance levels. Enough of support or resistance. Let's have some fun with the Forex Fun Fact of the day. So did you know that the Japanese invented the candlestick concept? So this guy, he's a Japanese rice trader. He's called Manahusa Homa. He's also called the god of the markets. He created the candlestick concept. He applied the principles of the yin and yang, bearish, bullish, to the markets to predict prices. And that's how the candlestick chart was born. So you could tell from the candle on the left, this is how it's all started, guys. All right. The candle on the right is the current candlesticks that we see and use on our computers. Now we're going to go into the chart patterns. So the 4 common chart patterns. These are really important. These are money makers. I'm telling you from now, these are the money making machines. If you catch one, take it. So we're going to start with the first one, double top and a double bottom. So let's go through the double top first. All right, guys. So this is a USD CAD chart, US dollar, Canadian dollar chart. I want you to notice 1 and 2, number 1 and number 2. So these were 2 major price rejections, all right? And they're almost at the same level, 1.4500. So what's a double top? A double top is when there's 2 rejection prices. And where do you sell? You sell on the second one after you get a confirmation. When do you get a confirmation? Usually after the rejection candle closes and the price goes a bit down, showing some bearish momentum. Then you can join in to sell with the other boys. I'm going to cover some more extensive details later in a separate video on how to trade these. So a double bottom would be 1 and 2. You can see the candles. They were getting rejected at the 1680 level. This is gold. All right, this is a weekly chart. You can open it and see it. These are all the charts I'm using are recent charts. 1 and 2, you would buy on the second closing of the candlestick. So look at number 2 candle, and you could see the candle after it. Right after that, everything was rising massively, hundreds of pips. All right. The third one was the recent crash that happened actually, and a gold crash, and the price did get rejected from the 1680 level. You could see it on number 3, and then the price went up right after the candle closed as a confirmation of a triple bottom. Now we're moving on to the heads and shoulder pattern. So this is a very common pattern. These patterns, you have to know them, guys. These are basics, all right? And this is still fun trading, easy money trading. Look at the zones I've colored for you in red. So you have to have for a head and shoulders to be valid, you need 2 shoulders and a head. So a shoulder on the left, a head that's taller than both shoulders, and a shoulder on the right that's almost as big as the shoulder on the left. So you could think of it as like a human being. He has 2 shoulders and a head. It's very, very, very clear. So where would you sell? You would sell right after the breakout of the support level of the right shoulder. Here is an inverse head and shoulders. So it's the complete opposite, and it's the same concept. All right. So there's the left shoulder, the head, and the right shoulder. So inverse head and shoulder is the opposite of a head and shoulder. Here you would buy at the break of the resistance shoulder. Again, we will get into more detail on a separate video. We're going through basics, okay? That's it. I'm going to do separate videos covering in detail, live if you want even. I might do that to go through each pattern and how to trade it properly and how to enter and exit the trade. All right, so let's do some candle knowledge now. Let's get into that. So following pictures of a candle, tails on both ends. So you can see the high. So you see the red candle has an open, a close, and the green candle has an open, a close, and both have a high price and a low price. So the way you should think about this is, if you open a chart, first you check the time frame, put an hourly time frame. This means that each candle is an hourly candle. So each candle that opened and closed is within that hour. The new candle that closed was literally the hour after it. It's the same concept if you lose any other time frame. So if you have a daily time frame, it's the same thing. Each candle is for the day, and when the day ends, a new candle opens, which signifies a new daily candle, a new day, basically. So I just want you to understand how a candle works. Basically, it's a fight between bulls and bears, okay? So just imagine there's a tug of war between buyers and sellers. The buyers are pushing, they're buying, and the sellers are selling. All right, so let's move on to some real candles right now. So these are formations of candles. If you see them, these are like signals, buy and sell signals. So let's start with the first one. It's a hammer. Let's take a closer look at it. It's the red candle. As you can see, it forms on a downtrend and indicates a possible reversal in price. It may show that the bulls have regained the ground and could see the price rise after the candle closes in this shape. So notice the shape. There's a long wick down there and the body's pushed up. It means the bulls have pushed the price back up, which means the trend be on a possible reversal. Holistically, you could look at the candle. Also looks like a real hammer. You see? Literally. So here's an example of a hammer in a chart that I dug up. This is recent. So you can see the downtrend red candles, and then the hammer popped up and boom, a few candles later, price reversed back up. So this is very common. You're gonna see a lot of hammers. The next candle we're gonna talk about is the hanging man. So the hanging man is exactly the shape of a hammer. Now, by the way, don't give any attention to the colors. Just focus on the shapes, okay? It looks exactly like the hammer, except it appears during an uptrend and causes a reversal to the bear side. So it causes the opposite effect. Look at the uptrend reversal. You will notice a man's head is hanging and a candle is his body. So holistically speaking, look at it. It's like a head with a body. This is how it's gonna look basically. So here's another example of a hammer, one more, just so you can get it through the head. So the upper shadow at least twice of the lower body, and the hanging man, you could see the hanging man on the upper area. You could see after the green candles, boom, hanging man, and boom, the price crashed back down. And you have to understand, the hanging man appears on an uptrend and the hammer appears on a downtrend. They both are indicative of price reversals. So now we're gonna take the inverted hammer. So this is how an inverted hammer looks like, okay? An inverted hammer appears on a downtrend and has the same impact on the price as a hammer. Look at this. It's usually double the body and reverses the price back up. It has the same effect as the hammer. So this is how the shooting star looks like. Again, you can see uptrend, the green candle uptrend, boom, it pops up, price falls. Now I'll also teach you how to trade these later, where to put the stop loss and the take profit. These will be in a separate video. Let's take a final look at the inverted hammer and the shooting star. The inverted hammer is on a downtrend, the upper shadow of the candle at least twice the lower body, and it's a warning of a potential bullish reversal. The shooting star, on the other hand, appears on an uptrend, and also the upper shadow of the candle is at least twice of the lower body, and it shows a warning of a potential bearish reversal. Lastly, we're going to talk about Greenroomfx. So basically, I give signals. If you need help with signals, that's my job. I've been doing it 5 years now. We have a big community of traders. Contact us. Let me know. We're here for you. Cheers.